Hey, it's Miss Kellie Michele. Welcome back to my channel. We have another episode with the Rental Revenue Builders collaborators. And today we are talking about financing. How do we finance our rental properties or just our real estate investment properties in general? The first question we have here is, how do you finance your rental property? Or your properties in general, because Marlon, I know you don't necessarily hold the properties. You usually wholesale them or you might flip them. So how do we finance our property?
Well, most of my properties, I'm getting them financed through either private money lenders or hard money lenders at this time.
Okay.
I found those the easiest barrier of entry because there's not really a background check being done with either one of these. They more so based off of the deal. But the only problem with that is that the interest rates are usually higher than the traditional loan. And also the down payments are a little bit higher as well. They usually have origination fees that are a lot higher than regular banks, things like that. But the goal is to get them cheap enough through a hard money lender to be able to refi them later on if I decide to keep them as a rental.
As a wholesaler, what is your ultimate purpose for financing? Because you're a little bit different than us who kind of hold the property. So what is your purpose for finance?
So my purpose with financing it is I can take it down and have control of it. Anytime I'm not financing a property, I'm at the mercy of a rental buyer or of another buyer. If I can take it down with a hard money loan or private lending, then I can decide how I'm going to dispose of it. So I can sell it on the MLS. I can decide to fix it up and then flip it that way. It gives me a lot more alternatives to my end goal of selling the property later on.
There's a difference between a hard money loan and a private money loan. And you mentioned both of them. So let's make sure we tell everybody, what is the difference between the two?
Yeah, I can go. So a hard money lender is typically going to be a company, even though a lot of hard money lenders out there say that they are private money lenders. It is a corporation that they gathered a group of investors or a group of lenders together, the money to be able to lend out to other investors. And it's very much on an asset base. So they're going to look over the asset, look at the numbers. What would you do after repair value? And those are the ones that are going to typically, like Marlon said, they will have a little bit stricter guidelines in the sense of how many flips have you done? What do you have under your belt? They won't go, some of them will do a soft credit check or a credit check. Some will just do asset base, and they are going to lend to you at a short amount of time. So typically they will lend to you about 6 months to 12 months. If it is going to, that's where they have the higher interest rate. So you will be paying an interest only payment every single month to them until you are out of that loan. A private money lender, which is a lot of what I like to work with as well, is going to be an individual person, friends, family. There are other actual investors and real estate professionals that all they do is lend their private money. So their money would be in their 401k. It will be in a whole life policy. It would be some type of attached to them of what they've worked very hard for. And they understand the concept of putting their money to work. So you're wanting to actually reach out to those individuals to be able to partner with you because you'll get a lesser rate. Right now, I haven't purchased in the last 90 days, but I believe that hard money is probably still around the 12% up to about 15, 18%, depending on your experience. Whereas sometimes you can get hard private money lenders anywhere from 8% up to 12%. And it's also not going to be as strict. Typically, these are more one-on-one relationships. They're going to trust you with their money. You're going to have a little bit of an easier way to be able to work with that money. And those private money lenders are not, most of the time, depending on how you set it up, you don't have to pay them interest only payments per month. They'll wait till the end of the project to be done. So it's a little bit more of a relaxed thing, but you do want to make sure that your numbers and you're understanding the deal and project because it's also a little bit more risky. So those are the two differences in those.
Okay, great. Thank you so much for explaining that, Michele. So since you are now telling us about this, how about you share? I know you talked about using private funding and you've used hard money in the past. Do you use any other type of financing for your properties?
Right now, if it's not my own capital, we have been leveraging a lot on the private money lending side. So when I first started my journey, it was a lot of my capital that was put into my deals because I didn't know what OPM meant, which means other people's money. And what I also saw was a mindset shift back then. I was like, I'm not using people's money. That's crazy. I'm not going to pay the interest rate. But in reality, as understanding the concept and understanding and starting to get some of these deals, it's actually an opportunity to be able to partner. So you want to really start to build those relationships when you're starting a single family with private money lenders, because it will carry over into Dom's world, which is multifamily. And that is all what multifamily is partnering with investors. And you can never get one deal funded just by yourself. It doesn't matter if you have a bank involved, you are always going to have others that are involved. So for me, we are in the transition of not utilizing any hard money lenders and really building. We're in the phase of what we call ourselves capital raisers. So all I am tasked with now, and so is my team, is that we are building relationships with investors. And these are lending investors. So there is a difference of the people that do the day-to-day operations. And there are individuals that just kind of, in my opinion, do the smart thing. And they say, hey, you guys do all the risk. You do everything. I'm just going to provide you the money and I'm going to have passive income and I'm going to make a return on my money. And I'm going to trust in you and in your product type of investor. But they don't have to worry about the day-to-day, the contractors, the staging. They just want to know, is the project on time? Is the project meeting the criteria? And am I going to get my money back when you said that you are going to give it to me with the interest that you give me? So to answer your question, we really highly leverage and we're transitioning to be 100% private money lenders. And when necessary, we will have to, if we have to leverage a bank, we will leverage that. But we're trying to get away from the hard money side.
So question, does that require you have to deal with like accredited investors, which are people that make over a certain amount of money? And once you get up to a certain amount, do you have to have any kind of credentials to start raising that type of money? Because can a regular person raise that type of money from anyone?
So you have non-accredited and accredited. So a lot of what we have been doing in a single family space is non-accredited. So there are individuals that are breaking into the industry stating, I don't know how to get started with real estate, but I have a 401k that's at $50,000, $60,000 and I'm in retirement and it's just sitting there. So there are 5 different ways that you can use your 401k and there's a transition in that of how to use it. But to answer your question, it is non-accredited. We've raised over $1 million right now. But the difference is that it does have to be attached to a collateral. So it does have to be attached to the asset. So the reason why we were able to raise $1 million was because we had 19 properties in our portfolio and we were able to leverage those, but it's really a one-on-one situation. So it's one property, one non-accredited investor. When we get into Dom's world, it is a syndication or fund. And with the syndication, those are when you get into the accredited and non-accredited. And there's when you have to start following the series of regulations and the Fed's regulations because you're dealing with a lot more money. You're dealing with someone that's going to invest $100,000 versus investing $40,000 or $50,000 into mine. Though it's still a significant amount, they're just different. So if for whatever reason, they become a note on that one property when it comes to residential, and if we don't pay that note back, they can foreclose on that property. So that's the collateral that they can have. When you start working in Dom's arena and multifamily, there is a big contract PPM, a big letter memoranda indicating that you are going to be taking that risk to be able to park that money, but also it can't be the money. And you should vet this out regardless, but it can't be a money that you have for your vacation or for your mortgage payment. There are just other regulations you have to follow going into that. And there's a lot of other benefits as well with that. There's benefits on both sides. So we work with non-accredited, and now we're getting into accredited investors as well.
Just so everybody understand that the accredited is if you make like $250,000 or more, and then unaccredited if it's like you make your income is less than 100 or less than $250,000 a year.
Mm-hmm. And there's information about syndications in the Rental Revenue Builders membership. So if you guys want to know more about accredited and non-accredited, there is some information about that. And there's a specialist who teaches people about syndications, and her information is in the Rental Revenue Builders membership. So keep that in mind if you want to learn more about syndication. Now, as far as me, when it comes to financing my properties, I've done a little bit of a variety. I've done some hard money. That's when I started off and I was doing a few flips. I don't really do too many flips these days, but my rentals, I normally buy them in cash, and then I have refinanced them to pull that cash back out of them. So at this point, I do have some properties because I like a mixture as far as cash flow is concerned. I do have some properties that I own free and clear, and I have properties that have loans on them just because, like I said, the cash flow perspective, I like those free and clear properties to give me all of my money. And then I can utilize, the funds I pull out of the other properties when I refinance to invest in other properties or other projects. I have gotten a private money loan, but it was for my midterm rental business. And that was a person that I knew who loaned me the money to invest in more rentals and get some more midterm rentals. So I do have one private money loan, but on the flip side, I usually have been the private money lender because I have usually loaned money to like Marlon as a private money lender for some of his wholesale projects that he wants to kind of turn around pretty quickly. So that is how I finance, my properties, and how I have been on the other side as far as lending money out as well. So let's go to Dominique. In the multifamily world, how are you financing your property?
Yeah, great question. I think starting off as a beginner in the multifamily space, I initially went straight to a mortgage broker, right? And that mortgage broker is very knowledgeable about different types of products that can fit my needs just based on my situation with my family. So just from a resource standpoint, we were using our 401ks, obviously assets and funds that have built up over time that were just sitting, right? And if you think about in 2022, just from an overall 401k standpoint and with the market, 401ks took like a 22% hit year over year. So if you think about where we parked our money and was that working for us, or we had to take a step back and think, okay, where do we park these funds just based on the performance of our 401ks as they were actually underperforming, right? So we got into the multifamily space, and I'm just going to be real. We're buying businesses, guys. We're putting 20% down, and the commercial bank is actually funding the rest of the 80% for the loan. And why do I say that? There's a lot of people online, they'll point you into the direction of putting 3 to 5% down to secure a 1 to 4 unit in. And I think that's great, right? But when you think about the overall aspect of cash flow and your goal, I think you're buying a business and you want to make sure you buy a profitable business. And sometimes the only way to make sure that you're buying a business that is cash flow healthy is to, one, make sure you're actually buying the right deal and making sure that you're buying it at the right number. But two, you got to make sure you're putting enough funds down to actually make sure you're making money. As interest rates rise to 6 and 7%, we make sure we're buying properties at a 9, 10, 11% cap rate, because at the end of the day, we want to make sure the bank is not making more money than us on the deal, right? And at the end of the day, like I said, we're buying at 20% down. We're leveraging some funds from our 401ks on the W-2 side. And, what I love about it is, that 20% down that we spend, that's not completely gone. That's not, disappeared, right? We're able to purchase these properties that are turnkey, but they may be under rented, or the rents are below market. And we're able to leverage Section 8 and government contracts to get higher rents on these properties, right? So in the first year and a half or 2 years, we're able to pull all of our 20% out with the HELOC and actually repeat and, kind of just continue that process of going to buy the next property. So even though the 20% down on a property may seem steep, in a year and a half, if you can go and raise rents and increase the income of that multifamily property, you're able to, really kind of leverage that property, get your funds back from a down payment perspective, and then rent and repeat that multifamily cycle. So that's my approach on how I've been taking down my multifamily deals from a financing standpoint.
So when you say, can you define what a HELOC is when you refinance out of it?
Right. And, I think that's a great question. HELOC is not necessarily a refinance of your whole specific loan. A HELOC is really kind of just looking at your property, looking at the total gross income, looking at the total expenses on your property, also getting an appraisal on the property, and really kind of just pulling out up to, maybe 80% of the loan to value on that property. So you're not touching your existing loan. You're literally just pulling out equity of that property, and you've increased the value, you've increased rent, and it's like a line of credit. Basically, it's a walking credit card, or a walking line of cash that you can use to not only buy more real estate, but, it may be for renovations on your current property or renovations on another property, right? So you're able to kind of just leverage as you go. And I think that's the best part about just getting into the multifamily commercial space.
All right. So we have heard a few things that I want to make sure you guys pay attention to. We've talked about hard money loans. We talked about private money loans. We talked about buying properties in cash and using a mortgage loan or working with a mortgage company to get a loan from a bank or mortgage company itself, right? But what about those people? And we also hinted on this, but we did not get into it too much. The people who don't have perfect credit or don't have great credit at all or don't have any money at all to kind of invest. What would be the perfect alternative for those people? Which option should they choose?
So, that is a lot. There's a lot to unravel in that, in the sense of a lot of people, when you're getting into real estate, and as you start getting into real estate, you'll realize, like I mentioned before, I was actually training on this week. There's almost like 50 different roles when you say, I'm a real estate investor, I'm in real estate. And we don't ever think about it, but you got your hard money lender, you got your seller, your buyer, you got your title company, and so forth. So as you start to build these relationships with others in the real estate industry, and as when you start to get into the real estate industry and you don't have that much education in regards to credit or how to leverage business credit, which a lot of people don't really talk about. And there's so many different avenues out there that you can, one, leverage business credit to purchase. Two, a lot of hard money loan lenders out there, you just have to find them, will go off of the asset, or they are called DSCR loans. And they will really look at that asset and what that looks like. But there are, no matter what, they do sometimes do a soft credit pull. But believe it or not, there are people out there, individuals that will sponsor your loan. So what that looks like is a joint partnership. There is a little bit more that you have to get into to make sure things are legal. But when you're getting into the actual space, the hardest thing is to make sure you got a good deal. And when you have a good deal and you actually have it, I promise you the money will come, the credit will come, the opportunity to be able to. And I know that when I first started out, I'm like, oh, what's the difference? When I hear partnership, I'm kind of a little scared. The difference between JV and an equity partnership. At the end of the day, guys, whatever your goal is, you're always going to have partnerships with individuals. I'll give you an example. Imagine purchasing 19 properties in 1 year. It did affect my credit score. My last refinances, I actually had to go into a partnership, and JV was someone to sponsor my loan. And so that was to be able to get the better interest rate, get the better, deal. And when I looked at it over time, we not only built a relationship, but it also was able to say, okay, now I know this is a good deal. We can do that. So Again, the biggest thing is that there are ways. I don't want people to get, especially when you're getting started, to be fearful. I don't have any money. I don't have good credit. When you have the contract and when you have a good deal, everything else will follow. And I'm sure everyone can attest to that here.
As soon as you think, oh, I don't know how I'm going to finance this, like you said, if it's a good deal and you put it out there, there are going to be plenty of people, because you guys have to remember, the people who have the money just sitting there and it's not making enough interest or gaining enough, they are eager to loan this money out and make more of a profit on their money. So trust and believe, you will find people to finance a good deal.
Yeah. And to piggyback off of that, off of Michelle's comments, I mean, I think obviously getting started in real estate, credit is a huge factor, right? But when it comes to the commercial side, I mean, to her point, like literally it's really about the deal. 80% of, whether they are going to invest in that deal is about, hey, is the deal healthy enough from a debt to income ratio? Also, what is your deposit relationship with the bank, right? It also comes down to, how much funds do you have sitting, in that bank? Do you use them often? What is your relationship with that current bank, right? So I think credit is a factor, but when it comes to, especially on the commercial multifamily side, when it just comes to those deals, it's really about, hey, is this deal healthy enough for the bank? And then also, what is this person's relationship with us?
I think that goes on both sides, on the single family side and on the commercial side. It comes down to relationships and your ability to present that deal to make somebody want it. Because I came from a background of not being able to have those funds available. Yeah. But if I was able to present the deal well enough and show that everybody's going to make money at this time, I've gotten a lot of deals funded that way. And especially in the beginning when I had terrible credit, if I had a deal that matched what somebody else was looking for, there was no shortage of people looking to fund that deal. And if I showed that I had some people that'll come in and help fix it up or whatever, then again, the shortage of people that wanted into the deal. And that's what I've found, that as a deal architect, that you have to kind of learn how to be. If you can educate people on how they're going to make money, there's no shortage of people who want to give you that money once they actually either like you or trust you in order to do that. That includes banks or it includes individuals.
Definitely. I mean, even when it comes to the individuals, if they see that you're doing good work, like you have a track record in real estate, or usually it's easier, if it's a person and they see what you're doing and they see that, you are reputable, they have no problem loaning the money and you paying them a percentage for that.
That goes to a good point, because a lot of the relationships, right? So I think the biggest thing that everyone needs to understand, and it's in any business, but especially real estate, is your relationships. And those have to be weight in gold, and really making sure that those relationships are constantly as you're evolving, because trust me, there are so many places I can say probably 6 months ago I was not in or privy to, and my journey of going, and that's anyone, and that's just growth within real estate. But to Don's perspective, you definitely want to have credit unions. You definitely want to have banking relationships. One of the things on one-on-one for real estate is, yes, we love the big banks. We love the Chases, the Bank of America, but you want to have a close community bank that you start building a relationship with. Because if you are getting into the real estate world, you are going to need to leverage it. The smart way would be to leverage the banks, leverage other people's money, and that includes banks. One of the biggest things I think that we forget and tend to forget is and Don mentioned this earlier, we are running a business. So with that, you do want to run as a business. You do want to get a LLC set up, or whatever structure your CPA or accountant. And we talked about this in a previous, what is the first, staff member that you want to bring onto your team? And accounting is a big thing. And so building that, as I mentioned earlier, business credit is an option. So when you're doing that, that means it doesn't affect your personal credit. And that also means you get bigger lines of credit. So there's a lot of things out there that talks about that. You guys have my information. We preach about that as well. I wish I would have known about business credit when I started entrepreneurship, period, because all of us typically will leverage our personal credit cards here, there for down payment. And it's affecting us if you're wanting to scale. And you can really tap out rather quickly on getting 2 properties in midterm rentals, or if you forget it, if you're getting into multifamily, even if you're wanting to buy a 1 to 4 unit, you can really quickly, that credit can go up and you can leverage that. So big emphasis on that, research that, how, for the business credit side of it, getting an LLC, because you are running a business regardless. You are wanting to do this. Even if it is you buy 1 property a year, you're still running another type of business.
Right. Earlier, Michele mentioned some advantages and disadvantages of using private money versus hard money. So does anyone else want to add in any other advantages or disadvantages to using one over the other?
I kind of wrote down a list of advantages and disadvantages of kind of using. It's kind of different, 4 different financing buckets that you kind of got. You got the conventional money. The hardest thing with that is just the barrier of entry with the credit scores. You usually need a 680 or plus. And if you're doing like investment properties, 10 to 20% down, those are some of the disadvantages to going with the conventional loan. The advantages are that it's usually a 30-year fixed rate, which extends the loan out quite a bit longer than most of the rates. And then it's just slightly above the prime rate that's out there. So the interest rate is pretty low. The hard money lenders is a 2 to 4% origination fee, which you got the basically two, or as far as points is what they call the interest rates that you have to come up with. And then it's 10 to 15% a year. So those are some of the cons. With private money, that's probably one of the best ones that I agree with, is that you kind of set those rates with the person you're dealing with. So you got a lot more control over it. But the small banks are kind of the way to go as well. But the negative part about that is that you usually have to have, again, a credit score 650 above, but the down payments are between 0 and 15%. And having those relationships, you can do them over and over again without continuing to use your own money. But like I said, the private money lenders are a little bit harder to find. The conventional banks are easier to find, obviously, but the barrier to entry is a little bit higher with the amounts. But smaller banks, if you build a good relationship with those banks, you can have a much better success of continuing long term in the business. So that's my take on the 4 different buckets of financing.
I think what Marlon said, it takes a while for you to build those relationships with private money. But once you do, I think the biggest thing that drawback from that is the life cycle, the sales cycle of building that. It took us 7 months before we could even get the first person to lend us money. So, and it was because you have to remember it's hard-earned money that each individual does. And they're super attached to that because they have to trust you to know that you know what you're doing and that you're not going to lose their savings and everything that they've worked for. So that is kind of that's a drawback. Another thing is, and that's in anything, you have to be very well educated when it comes to your numbers, when it comes to certain things, and then knowing your boundaries. I've gone to some, and this is not hard money lenders or private money lenders. I've gone to some lenders and they're like, I want your first child. I want this. And I'm like, hold on. If the banks are asking this, why are you asking this from me? And also with hard money lenders, you start to have a track record and they'll say, oh, we got to give it to you at 12 or 14%. I'm like, I've done X amount of flip, or I've done X amount in my portfolio, and you have to negotiate. So one of the things is, even when I did my first one, guys, when I had my first property, I didn't know what the heck I was doing, but just a sales background, I called 3 to 5 different lenders and I went against them because people do understand in hard money, as I mentioned, it's a pool of other investors that are funding those particular deals. And what happens to hard money lenders, if they don't have the money out to work, they get into trouble. So what I'm trying to explain to you is you can have it where you can compare and say, well, I'm getting it from this lender and I'm getting this, and you can negotiate your rates a little down to be able to get a little bit. And even if half a point goes a long way, or like Marlon said, the origination point, goes a long way. When you think your property is going to be 3 months in construction, it really sometimes go to 6 because construction always is one of those things. We talked about that before. So drawbacks on both, but private money, I would say it's super long a relationship. But once you get that going, you should be able to build and continue to build those relationships.
One thing I didn't understand when I was at the beginning of borrowing money was a simple fact, like I'm gonna piggyback on what you said, is that people have to use the money. I've had money where somebody's, I've presented a deal, they've committed to the money, and maybe I got a better rate somewhere else. But if you don't use the money, they will find somewhere else to use it, and that used to scare the heck out of me because I didn't understand. All right, I got this money sitting over here. I'm gonna use it whenever I want to. But people want to make money, and that's one of the things that, as a new investor, you don't really understand is that you think the hardest thing to do is go out and get the money, but people want to give you money if you have a good enough deal, and if you don't use it, they'll just go to somebody else. And that's one of the biggest fears that I had about dealing with the whole private money is that losing money. So I'm going to try and find a deal, and I gave away money in a deal just to build trust with a couple different private money lenders, meaning that now that I have control of a deal with this private money, I'm just going to sell the deal just to get the private money's lenders or the lender their money back. And then so I can use more money in the future and build their trust. And that right there has gotten me more money just by closing deals that at a quicker rate or recycling their money faster has gotten me a lot more private money than anything actually.
So yeah, that's a good tip. So everybody, I hope you heard that and you were listening to, if you get a hard money, make sure, you sell their property instead of trying to hold on to it, or either cash out to make sure you get that person or that hard money lender their money back, or that private lender their money back as soon as possible, or whatever it may be. But like Marlon just said, building that relationship, and Michele said the same thing, building those relationships, getting those loans, paying them back, showing you're responsible, showing you know what you're doing, that will all help in the long run. All right, so let's move on. And this is going to be our last question here because lending has changed over the years. I know since I've started investing, things have changed. There was a time when you could go to a hard money lender and they would fund you most of the deal, right? Then things changed where you had to have skin in the game and you had to bring so much to the table before they would give you a loan. I'm not sure because I'm not using a hard money lender now at this point what things are, but tell us as lending has evolved and there are other emerging trends with financing. What are some other innovative options that people should be aware of? Or we could just tell everybody how things have changed and what they should be aware of.
This would have been one for Alejandro.
Yeah, I know for us, we changed from last year to this year. Last year, we were buying a lot of cash deals, and now we're buying a lot of creative finance deals. What does that mean? It's been around for ages, it's starting to come as a trend right now. I would say there's one main marketer that has been marketing it, and that's what they do. But it's creative finance subject to the mortgage. So what does that mean, guys? Is that there actually could be, if someone's trying to sell their property, you can actually purchase their property with keeping their mortgage still in place, and you continue to make the payment. And so you continue to keep that lower interest rate. So that is something, like I said, that's not new, but it's starting to come to the surface a little bit more in 2023 because of the fact of the interest rates being higher. So subject to the mortgage or even seller finance, a lot of that is in commercial space. A lot of that is also in the residential space. And what the difference is seller finance is that the property is paid off like Miss Kellie has, and she may want to get rid of her property. She could become the bank and she could charge me interest as I make payments to her. So then she'll make actually more money over time. And there's also some tax benefits in that. So those are some of the trends we're currently, we're on for 2023 because the interest rates, especially that I purchased a lot last year, we were at a certain interest rate at the beginning of the year. And then at the end of the year, I finally was able to refinance those, but some of it did take away from my profit. So we just made a business kind of pivot this year to only buy creatively, into, and that is like a whole thing in itself as far as that. So that's kind of what we've done.
Most people don't realize that with real estate, it's not like a car title. A car title might have a lien and the title in the same document. With real estate, you have a mortgage and you have a deed of trust. Those two are two separate things. A deed of trust is basically a loan on the property, and that can stay in place. The deed is a title. The title can stay in place while you actually still have a mortgage on the property. You can sell the property and keep the mortgage in place. And most people don't know that's even an option. It's fairly risky, but at the same time, it'll stop a lot of people who may find themselves in financial distress, and it'll give them alternative to get rid of the property today versus waiting for somebody to come with the full mortgage and things like that, because it'll give them a chance to take over that mortgage that you have and continue to make the payments, and you get the benefit of the good credit and things like that while still selling the property to someone else.
So I got a quick question on this. When I hear subject to and creative financing, I'm just like, this is music to my ears as an investor, right? So what are some of the disadvantages to the person who owns that property, right? Because I'm thinking like, okay, this sounds great to me 100%, but is this something that will work out, in favor of the owner?
Absolutely. So there's a lot that's involved. You definitely want to have an attorney that is going to be involved in this. You would never want to do this on your own in regards to if it's your first time, but even when it's not, we get those individuals involved. So honestly, into the actual seller, that is a question that's always brought up. So one of the things is that there is a document that's signed if for whatever reason, and say I'm the buyer, I skip on a payment, you can go ahead and get that into the title switch, go into foreclosure and regain that property back if for whatever reason we miss a payment. Typically how to protect also the seller is we'll get a third party company, a service company that will service the property for the length of that. So usually when you're doing subject to, it's just like Marley was saying, someone's going into foreclosure, and that means like foreclosure within 30 days. So their credit's already shot. So what we're doing is we're coming back in. And so we're saving them from bankruptcy, right? And saving them from bankruptcy, you have to remember, follows you. So you can't get a car, you can't get another house, you can't get anything. So we're saving you from that. And we're also going to help you reestablish your credit because it's going to stay on there. So those are the common questions we have. We also have a common question. Well, what about my debt to, if I want to go get another house, my debt to income, my DTI? Because there is a servicing company established, and just like Marlon stated, the deed of trust is going to be transferred. It's showing now that it's technically like an investment property for you, so they don't utilize it against you. And believe it or not, you could do this in multifamily as well. So there's and definitely there, because a lot of people that have buildings and so forth, they're doing it as you have to the capital gains and the 1031 exchange kind of scenario. So those are just some of the advantages, but we get those questions all the time, like, why? What if I don't trust you? What if you mess up or something? And just like anything, they're going to have already something pre-signed and they can go ahead and do that. The disadvantage for a buyer, which technically it can happen. Like there's another thing is a due on sale clause. The due on sale clause is something that a bank, what they'll say is, hey, we saw that you all of a sudden have been making more payment. What's going on? We didn't give the loan to you. And then there's a couple of strategic things, just like anything in business, to be able to battle that due on sale clause. But there's an individual, his name is Ace Morby. He's done so many of these transactions, and maybe 1% of his loans have been due on sale clause, and he's only had all of them have been cured, so to speak. So it's a little bit of a different, kind of strategic alternative as far as how to get into real estate. I would definitely recommend educating yourself on this and there's different parties that are involved in this. You always have to have an attorney. You always have to, depending on an attorney or title state. But believe it or not, in every state, there is an attorney or a title state that do subject tos and wraparounds in all the creative side of real estate.
Right. And a lot of it involves putting everything in trust, because there is you can have asset protection. Like everyone have the right to have asset protection, and putting properties into trust and things like that usually doesn't pull up a lot of red flags when it comes to selling the property. So a lot of them that we've done to avoid a do on sell clause, or even triggering the insurance company which wouldn't trigger the finance company, would to have it built into a trust, and then have, somebody else as a trustee.
And one thing I want to just make sure the viewers know is that you do still have to have some type of cash to do a subject to. Usually, even if it's just to bring the loan to current status, if that person is 3 to 4 months behind on their mortgage, you need to bring that up, because you have to have that money available to do that. Also, sometimes people may need some assistance moving out. So you may have to give the person who owns the property a little bit of money for them to get out of the house and get set up somewhere else, so that you can take that property over. So I don't want you guys to think that you can just get into this and you don't have to have any kind of money or anything like that. You do, but there are also people who will loan you money if it's, again, a good enough deal. There are some people who would loan you money to get that done, and joint venture or partnerships or anything like that. It's a variety of scenarios. All right. So I think that we are good as far as the conversation about financing. So you guys who are watching, make sure you tune in for the after show. The after show is located in the Rental Revenue Builders membership. So we're going to be talking more about our personal experiences and sharing stories around financing in our real estate businesses. So you can check that out by joining the membership. And make sure you like and subscribe to my channel so that you can see future episodes of the Rental Revenue Builders Collaborators and us talking about real estate in general. Thank you guys for tuning in. And if you want to get the links for the membership or any other information, that is going to be in the description below. All right, so we'll see you next time. Bye.